Have you ever thought of creating a passive income stream? Well, it's not as straightforward as it seems. You also need to be aware of how passive income is taxed. Hello and welcome to my channel. Today I'm going to be discussing how passive income is taxed. Whether you're a freelancer or have rental property, understanding the various tax implications of passive income is important in creating a secure financial future. In this video, I'll go over the rules and regulations regarding taxes on passive income so that you can make sure you're complying with the law and maximizing your finances. So let's get started with an introduction to passive income. Passive income is a form of income that requires little to no effort to maintain and generate. This type of income can come from various sources, including investing, rental property, royalties, dividends, and online businesses. Passive income is appealing as it allows individuals to make money without actively working for it. Investing in stocks and mutual funds are two common forms of passive income, as these can generate income without much work. Rental properties are also a great form of passive income as they require minimal effort to produce an ongoing stream of money. Additionally, royalties from books, films, and music can provide another source of steady income. Finally, setting up various online businesses such as e-commerce sites or affiliate marketing programs are also viable options for passive income. All of these sources require a certain amount of effort to start off, but once established, the results can lead to steady income with minimal ongoing work. But did you know that passive income is indeed taxed? It may come as a surprise, but self-employment and ordinary income tax rates apply to most forms of passive income. That said, there are certain deductions you can take advantage of to help reduce this tax burden. That's why it's so important to talk to a qualified tax advisor who can give you the best advice on how to manage your passive income taxes. Doing so will help ensure that you only pay what is legally required and keep more of your hard-earned money in your pocket. So don't forget to consult a qualified tax advisor when dealing with any questions concerning taxes on your passive income. That way, you can rest assured knowing that you'll be getting the most out of your earnings. Plus, passive income taxation is a complicated process, but understanding the basics can help you make informed decisions about how to manage your investments. When it comes to passive incomes, there are many types of income sources, and each one is taxed differently. Knowing the differences between rental property income, dividend income, interest income, capital gains, and royalty income can save you money in taxes. But depending on the type of income you receive, the tax rate for each may vary, so it's important to understand how these different types of income are taxed in order to plan accordingly. Dividend income from qualified businesses or investments is a great way to generate passive income and has the benefit of being subject to favorable tax rates. Qualifying businesses include those that pay dividends on stocks, mutual funds, ETFs, and other forms of equity-based investments. Dividend income is taxed at either the long-term capital gains tax rate or the ordinary income tax rate, depending on how long you've held the shares. This means that if you hold your investment for at least 1 year, any dividend income that is generated may be taxed at a lower rate than regular income. Interest income earned from taxable investments is generally taxed at a lower rate than other sources of income, such as wages or salaries. This means that if you earn interest income through a taxable investment, the tax liability on the money you receive may be much lower. Now, when renting out a property, it's important to remember that any money earned from this activity must be reported on your taxes. This means taking into account the expenses associated with running the rental property and deducting those costs from the income before calculating the taxable profit. It's essential to keep accurate records of all rental-related expenses so they can be deducted and to make sure that any taxable income is reported accurately. Capital gains are subject to different tax rates depending on the type of asset and how long it was held. Generally, short-term capital gains are taxed at higher rates than those of long-term investments. Short-term gains, which are classified as assets that have been held for 1 year or less, will be taxed at the same rate as ordinary income. Lastly, royalties are taxed at ordinary rates ranging from 10% to 37%, depending on the individual's income. These taxes are applied across all forms of royalty payments, including music, publishing, and software development. As such, it is important for anyone who earns royalties to be aware that the money they receive is not only subject to taxation, but also to other legal requirements such as the filing of tax returns. When filing tax returns, you must be aware of all the different types of income that need to be reported, as well as their respective tax rates. If you are unsure of the rules, it's important to speak with a tax professional or use resources available online to make sure you are filing correctly. Additionally, planning ahead to minimize taxes is also beneficial. For example, if you know that your income will be higher this year than in previous years, you may want to consider making investments in order to lower your taxable income. Plus, one of the most important things to keep in mind when considering claiming passive income as taxes is that you must properly report it on your tax return forms. Despite types of income having different filing requirements, and failure to comply with them can result in hefty fines or even penalties if the Internal Revenue Service, IRS, deems it necessary. It is also important to remember that claiming too much in passive losses can open you up to an audit, as the IRS may look askance at large amounts of income which could appear suspiciously high compared to what you've reported on your tax return. Now, when considering whether or not to claim passive income as taxes, there are both advantages and disadvantages that should be considered. On the plus side, claiming active losses against passive gains can reduce your overall taxable liability by offsetting gains with deductible losses from other sources of passive income such as rental properties or dividend payments. On the downside though, claiming too much in passive losses can open you up for an audit, since some of these incomes may not be reported properly on tax forms or could appear suspiciously high in comparison with reported earnings overall. Ultimately, deciding whether or not to claim passive income as taxes is a personal decision that should be made after considering both the advantages and disadvantages. With careful consideration and proper planning, it can be a great way to reduce your taxable liability while still taking advantage of certain tax breaks. One of the most effective strategies to maximize savings when dealing with passive incomes for tax purposes is to offset multiple sources of passive gain or loss. This can help reduce your overall tax burden by allowing you to save money in retirement accounts, 529 plans, and other investment vehicles that are eligible for beneficial tax treatment. Additionally, having family members generate additional passive income can also help reduce taxes due to their low marginal rates based on their filing status and dependent status. It's important to assess different financial vehicles and determine which will provide the best tax advantages in any given situation. You should also take into account the time frame of your tax savings, as some strategies may have more long-term benefits than others. It's essential to consult a qualified tax professional who can help you maximize your savings and make sure that you're taking full advantage of all the available deductions. Overall, understanding how taxation works with respect to passive incomes can help investors make wiser decisions regarding their finances while ensuring they abide by governmental regulations with respect to filing accurate documents each year during income tax season. With the right guidance, you can ensure that your financial future is secure no matter what kind of passive income you're earning. Well, that's all for today. I hope that you have learned about how passive income is taxed and why it is important for your financial planning. It is essential to be aware of these regulations so that you can make informed decisions when considering various income sources. If you found this information useful, please like and subscribe to my channel to get more such helpful insights. Thank you for watching.